Before we dive in, please remember that the content in this video is for educational and informational purposes only. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. I am not a financial advisor, and this presentation should not be considered as financial or investment advice. Any decisions you make based on this information are your sole responsibility. Please conduct your own thorough research and consult with a qualified professional before making any investment decisions. It's 2 in the morning. The New York session is long over. London is still hours away, and the only light in the room is the cold glow from your screen. You're staring at a candlestick chart, your eyes are burning, and you're trying to convince yourself that the perfect setup on the euro to US dollar is just around the corner. We've all been there. That feeling of being chained to the charts, the constant fear of missing out on a move while you sleep, while you're at your day job, while you're trying to live your life. You've done all the work. You've drawn your trend lines, you've set your support and resistance, you've got your indicators lined up. But the market doesn't care. It moves on its own time, driven by forces so vast and complex that no single human mind can possibly track them all at once. But what if the most successful Forex trader in the world right now isn't human? What if it's an algorithm that never sleeps, never gets tired, never feels the sting of greed or the panic of fear? An entity that can read every economic report from every central bank, analyze the sentiment of a million tweets, and backtest a decade's worth of tick data across 28 currency pairs, all in the time it takes you to sip your coffee. This isn't science fiction anymore. This is the new reality of the financial markets, and it's a reality that is becoming more accessible to the retail trader every single day. And that is exactly why you are here. Over the next 10 parts, we are going on a journey to demystify the world of artificial intelligence in Forex trading. This isn't about finding a magic get-rich-quick button. Those don't exist. This is about something far more valuable. It's about understanding and potentially leveraging one of the most powerful technological shifts of our generation to gain a new kind of analytical edge. We are going to explore the tools, dissect the strategies, and uncover how you can potentially use AI not to replace your judgment, but to supercharge it. To become the pilot, with an incredibly powerful AI co-pilot sitting right next to you. For years, the game has been played the same way. You learn technical analysis, patterns, indicators, Fibonacci levels. You learn fundamental analysis, interest rates, GDP reports, inflation data. And you try to synthesize these two massive fire hoses of information into a single coherent trading decision. The problem? The sheer volume of it all. As you're analyzing the latest non-farm payroll number out of the US, a surprise announcement from the Bank of Japan sends the yen screaming in the other direction. While you're focused on your 4-hour chart, an institutional algorithm executes a massive block trade that invalidates your entire setup in a split second. We're human. We have cognitive biases. We get tired. We fall into patterns. We are fundamentally limited in the amount of data we can process. The market, however, has no such limitations. This is where AI enters the picture. And I want to be crystal clear about what we mean by AI. For a long time, trading bots or expert advisors have been around. Many of these are just simple rules-based programs. If the 50-day moving average crosses above the 200-day moving average, then buy. That's not AI. That's just a calculator following a pre-programmed formula. It's rigid. It can't learn, it can't adapt, and it will apply the same dumb rule in a quiet, trending market as it will in a volatile, news-driven market, often with disastrous results. True artificial intelligence, specifically the subset we're interested in called machine learning, is fundamentally different. Think of it like this. A simple moving average crossover bot is like a cook who only has one recipe. No matter what ingredients you give them, they're going to try and make the same dish. A machine learning model is like a master chef that you've allowed to study thousands of cookbooks. It learns to recognize the subtle relationships between ingredients, the data points. It starts to understand that certain ingredients, like high volatility and a specific news release, tend to lead to a certain dish or market outcome. It doesn't just follow one rule. It learns from a vast history of data to identify complex, multidimensional patterns that your human eye would never, ever be able to spot on a simple price chart. It learns to weigh the importance of different factors. How much does a speech from the Fed chair matter compared to an inflation report from Germany? How does the price of oil correlate with the Canadian dollar? But only on Tuesdays after a specific inventory report. These are the kinds of intricate, nonlinear relationships that AI models are designed to uncover. They sift through the noise to find the potential signal. This entire series is built to give you a framework for thinking about these tools. We're going to start from the ground up. Today, we're laying that critical foundation. In the parts to come, we will get our hands dirty. We'll look at specific categories of AI tools available right now. We'll explore platforms that use AI for predictive forecasting, attempting to map out potential future price paths. We'll examine tools that perform sophisticated sentiment analysis, scraping news sites and social media to gauge the market's mood. We will even dive into AI-powered pattern recognition software that can identify complex harmonic or candlestick patterns across every single currency pair and time frame simultaneously, freeing you from the need to be a hawk-eyed chart watcher 24/7. We'll look at case studies, we'll discuss potential implementation, and we will cut through the marketing hype to see what is real and what is just a buzzword. But it all starts with this fundamental question: how does this new technology actually change the way we analyze the market? Forget the complex math and the intimidating jargon for a moment. At its core, the advantage of AI comes down to three things: speed, scale, and objectivity. Speed is obvious. An algorithm can perform calculations in a nanosecond that would take us hours. Scale is its true superpower. A human trader might track 5 or 6 currency pairs, a few key economic indicators, and maybe the price of gold. An AI can track everything. All pairs, all commodities, all indices, all news feeds, all central bank statements, all at once, all the time. It sees the entire battlefield, not just the little corner you're focused on. And finally, objectivity. The AI doesn't care that you had a winning streak yesterday. It doesn't get cocky. It doesn't have a bias towards going long because it feels like the dollar is strong. It doesn't get scared and close a position early, or get greedy and hold on too long. It operates purely on the statistical probabilities derived from the data it has learned from. It removes the single biggest point of failure for over 90% of traders: destructive human emotion. So the paradigm shift is this: moving from a state of information overload, where you're desperately trying to piece together a few fragments of data, to a state of information synthesis, where a powerful tool is helping you connect the dots on a massive scale. It's about augmenting your own analysis with a layer of data-driven insight that was previously only available to billion-dollar hedge funds. Now, this all sounds great in theory, but how does it work in practice? How does a machine actually learn from market data? The process, in a simplified sense, involves feeding the model enormous amounts of historical data. We're talking every price tick, every volume spike, every economic release for years. You show it thousands of examples of what the market looked like right before a major upward move. You show it thousands of examples of what it looked like before a crash. The model, which is essentially a complex network of algorithms, adjusts itself over and over, trying to find the hidden variables and correlations that were present in those past scenarios. It's not just looking for a simple pattern. It's learning the texture of the market that precedes certain outcomes. So when it sees a new live market situation, it doesn't say, "This is identical to what happened on May 15, 2019. Instead, it says, "Based on the 57 variables I'm currently tracking, this situation has a 72% statistical similarity to past scenarios that resulted in a price increase over the next 4 hours." It's a probabilistic approach, not a crystal ball. And that distinction is the most important thing to understand. There is no certainty. There is only raising the probability of being on the right side of the market. So we know what AI is, and we know its power comes from speed, scale, and objectivity. But how does this actually translate into a tangible edge on your screen? How does an algorithm look at a simple US dollar to Japanese yen chart and see something that we don't? What are the specific inputs it's looking at, and what does its output actually look like? Is it a simple buy or sell signal or something more nuanced? That is the bridge between theory and practical application, and it's exactly where we're going next. So let's pull back the curtain and look at the engine itself. The first question we have to answer is about the inputs. What fuel is this AI engine actually running on? It's not magic, it's data. A colossal, almost unimaginable amount of it. Think of it less like a simple calculator and more like a global intelligence agency, constantly absorbing information from thousands of sources at once. At the most basic level, the AI consumes all the traditional data that human traders have been looking at for decades. This is your price action, the open, high, low, and close prices for every currency pair across every conceivable time frame, from 1-minute charts to monthly charts. It's looking at trading volume, seeing when money is flowing into a currency and when it's pulling back. And of course, it's processing hundreds of technical indicators, moving averages, the relative strength index, Bollinger Bands, MACD, Ichimoku clouds, you name it. But here's the critical difference. A human trader might focus on 2 or 3 favorite indicators on a couple of time frames. Their brain is physically incapable of doing much more. The AI, however, is looking at all of them all at once across all time frames simultaneously. It's searching for subtle, multidimensional correlations that no human could ever spot. It might find a pattern where a specific divergence on the 15-minute RSI, combined with the price crossing the 50-period moving average on the 4-hour chart, but only when the weekly MACD is above the zero line, has historically preceded a significant price move 70% of the time. That's a level of pattern recognition that's just not in our biological toolkit. But that's just the appetizer. The real main course, the data that gives these AI tools their potential edge, is what we call alternative data. This is where it gets really interesting. First, there's sentiment analysis. The AI is effectively reading the entire financial internet in real time. It's scraping millions of data points every second from news articles, reports from major banks, social media platforms like X and Reddit, and financial blogs. But it's not just looking for keywords like euro or yen. It's using advanced natural language processing to understand the sentiment and the context. Is the tone of an article about the US dollar bullish or bearish? Is the language in a central banker's speech becoming more hawkish or more dovish, even if they're using the same old phrases? It can detect subtle shifts in collective emotion, a rising tide of fear or a groundswell of greed, often before it's fully reflected in the price chart. It's like having a superpower that lets you listen to the whispers of the entire market at once. Next, it's ingesting a torrent of macroeconomic data. When a major economic number is released, like the US non-farm payrolls report, a human trader sees the headline number and reacts. The AI sees that number, but it also instantly compares it to the consensus forecast, analyzes the revisions to the previous month's data, cross-references it with other related data points like wage growth, and most importantly, it has a perfect memory of how the market has reacted to every similar data release in the past 20 years. It calculates the statistical probability of different market reactions based on historical precedent, all in the fraction of a second it takes for the news to hit your screen. Then there's the mind-bending world of intermarket correlations. The Forex market doesn't exist in a vacuum. The value of the Australian dollar is often linked to the price of commodities like iron ore. The Japanese yen is often influenced by flows into global stock markets. The US dollar is deeply connected to the yield on US Treasury bonds. A human can try to keep an eye on these relationships, but they are constantly changing, strengthening, weakening, and sometimes even inverting. An AI can monitor thousands of these correlations in real time. It might detect that the historical relationship between the price of crude oil and the Canadian dollar is starting to break down, flagging it as a statistical anomaly that could signal a major shift in the market. Now, I know what some of you are thinking. This sounds like a black box. You pour all this data in one end, a decision comes out the other, and you have no idea what happened in between. And for early, simpler versions of trading AI, that was a valid criticism. But the field has evolved. We're now in the era of what's called explainable AI, or XAI. The goal of the best modern tools isn't to just give you an answer. It's to show you its work. It's designed to lift the lid on that black box. This brings us to the second and arguably more important question: what does the output actually look like? If you're picturing a giant, flashing buy or sell signal on your screen, you're thinking too small. The output of a sophisticated AI analysis tool is far more nuanced and far more valuable. First and foremost, it's about probabilistic forecasting, not absolute certainties. The AI doesn't say, the price will go here. Instead, it says something like, based on the current sentiment data and historical volatility patterns, there is a 75% probability that the euro to US dollar will remain within the range of 1.0700 and 1.0850 for the next 24 hours. This is a game changer for risk management. It allows a trader to set stop loss and take profit levels based on statistical probabilities, not just guesswork or static lines on a chart. The output often includes advanced pattern recognition. The AI can scan every chart and identify complex harmonic patterns, Elliott wave counts, or Wyckoff schematics that a developing trader might miss, or that even an expert might only spot after hours of analysis. But it doesn't just draw the pattern. It provides a data-backed confidence score. It might say, a potential Gartley pattern is forming on the pound sterling to Japanese yen 1-hour chart. In the past, patterns with this specific structure and volume profile have resolved to the upside 68% of the time. Another powerful output is anomaly detection. The system builds a deep understanding of what normal market behavior looks like. When something deviates from that norm, it raises a flag. This isn't a trade signal. It's a crucial piece of intelligence. It could be a warning that says, the VIX index or the market sphere gauge is unusually low given the negative tone of recent news headlines. This discrepancy has historically preceded a spike in volatility. That's an alert that tells you to be cautious, to tighten your stops, or perhaps to wait for a clearer picture to emerge. Finally, the most advanced tools provide dynamic scenario analysis. They use the mountain of input data to run thousands of simulations of potential future paths for the market. The output might be a visual heat map on your chart, showing the most probable areas where price might go next. Or it could be a series of if-then scenarios. For example, Scenario A. If the upcoming inflation report is higher than expected, our model projects a 70% chance of a sharp move up to this resistance level. Scenario B. If the report is in line with expectations, the most likely outcome is continued consolidation in this range. So, you see, the bridge from theory to practice is built on this transformation. The input evolves from simple chart data to a holistic global information network. And the output evolves from a crude buy or sell command to a sophisticated probabilistic co-pilot. It's not about replacing the trader's judgment, but augmenting it with a layer of data processing and statistical analysis that is fundamentally beyond human capability. It's about being able to ask the market, what is most likely to happen next? And getting an answer that's grounded in data, not just emotion or intuition. We now understand the ingredients, the vast datasets, and we understand the final dish, the nuanced probabilistic outputs. But who are the chefs? Which companies and platforms are actually building these tools and putting this power into the hands of traders? In our next part, we'll start naming names. We will pull back the curtain on some of the key players in the AI Forex analysis space, exploring how their interfaces translate all this complexity into a dashboard that a trader can actually use to inform their decisions. First up, let's talk about the category of tools I like to call the automated chartists. These are the platforms designed to be the ultimate technical analyst, working tirelessly 24/7, never getting tired, never letting emotion cloud their judgment. A prime example of this philosophy in action is a tool like TrendSpider. Now, the core idea here isn't to create a magic black box that just spits out buy or sell signals. The goal is automation of a tedious, repetitive, and critically important process: drawing on charts. Think about how a traditional technical trader works. They spend hours day after day drawing trend lines, identifying support and resistance zones, plotting Fibonacci retracements, and looking for classic chart patterns like head and shoulders or double bottoms. It's a craft, but it's also incredibly time-consuming and, more importantly, subjective. My trend line might be slightly different from yours. Did I draw it from the wick or the body of the candle? That single decision could change the entire analysis. The automated chartist says, let's remove that subjectivity. It uses algorithms to mathematically analyze price data and draw these key levels for you, based on a consistent set of rules. When you log in, you don't see a blank chart. You see a chart that's already been analyzed. It's as if you hired a whole team of veteran analysts to prep your charts before you even sat down at your desk. The interface is typically designed for clarity. Instead of a mess of lines you drew yourself, you see clean, algorithmically generated trend lines that automatically adjust as new price data comes in. One of the most powerful features you'll often find in these platforms is something called multi-time frame analysis, all on a single chart. This is a concept that trips up so many traders, but it's fundamental to understanding market structure. Here's how it works. A bullish pattern might be forming on the 15-minute chart, suggesting the price is about to go up. But if you zoom out to the 4-hour chart, you might see that this little upward move is happening right as the price is about to hit a massive long-term resistance level. The AI makes this connection instantly visible. It will show you the trend line from the 4-hour chart overlaid directly on your 15-minute chart. Suddenly, you have context. That small bullish signal is now seen for what it is: a potentially risky trade right into a wall of sellers. The AI isn't making the decision for you. It's presenting you with a more complete, unbiased picture of the battlefield, so you can make a more informed one. It's about reducing blind spots. Another killer feature is the automated pattern recognition. These platforms can scan dozens of currency pairs simultaneously, looking for specific candlestick patterns or classic chart formations. Imagine setting an alert not just for a price level, but for the formation of a bullish engulfing pattern on the hourly chart of the euro to US dollar. But only if it happens at a key support level. Trying to monitor that manually across multiple pairs is nearly impossible. An AI can do it without breaking a sweat. This frees up your mental energy. Instead of hunting for setups, the setups come to you. You evolve from being a hunter to being a patient sniper, waiting for the high probability targets that the AI has already scouted. The value proposition here is immense. It's about saving time, reducing human error, and enforcing discipline by building your specific rules directly into the analysis. But that's just one side of the AI coin. That approach is all about price action, the what of the market. What about the why? What about the news events, the central bank announcements, the geopolitical tensions that are the real fuel for major market moves? For that, we need to look at a completely different breed of AI tool. Let's call this category the narrative analysts. These platforms are less concerned with chart patterns and more concerned with text. They are built on sophisticated natural language processing, or NLP, which is a fancy way of saying they are designed to read and understand human language on a massive scale. A platform in this space, something like an Acuity or a Kavout, isn't just looking at the euro/dollar chart. It's reading every article from Reuters, Bloomberg, and the Wall Street Journal. It's scanning thousands of tweets from influential financial accounts. It's parsing the official statements from the Federal Reserve and the European Central Bank, word by word. And it's not just reading. It's understanding. It's looking for sentiment. Is the tone of the news surrounding the Japanese yen becoming more positive or negative? It quantifies this by identifying keywords and phrases and assigning them a sentiment score. This allows it to create what is essentially a real-time data feed for market mood. The dashboard for a tool like this looks very different. You might see a sentiment score for the British pound that ticks up and down like a stock price, reflecting the collective mood of all the news and social media chatter related to it. Let's walk through a case study. Imagine the Federal Reserve Chair is giving a speech. A human trader has to listen, interpret the nuances, and then quickly make a decision. The AI is doing something else. It's comparing the text of this speech in real time to the text of every previous speech the chair has given. It might detect that the word inflation is used 15% more frequently than in the last statement, or that the phrase strong labor market has been replaced with moderating labor market. These are subtle shifts that a human might miss in the heat of the moment. The AI flags these changes instantly, quantifies them, and presents a hawkish or dovish score shift on your screen. It can show you that the market's initial reaction might be wrong, because the underlying language signals a policy shift that most people haven't priced in yet. Another powerful application is event analysis. These tools can look back at years of historical data to answer questions like, how has the Australian dollar typically reacted in the 24 hours after an interest rate hike from the Reserve Bank of Australia, when inflation was also above 3%? It sifts through history to find analogous situations, providing a statistical breakdown of potential outcomes. This isn't a crystal ball. It's a historical guide. It's like having a seasoned economic historian as your research assistant, giving you the context behind the headlines, so you can see the clear difference in philosophy. The automated chartist believes that everything you need to know is reflected in the price. The narrative analyst believes that price is a lagging indicator of human emotion and global events, and to get an edge, you need to analyze the source code of that emotion language. The first tool helps you perfect your timing and entry/exit points based on technical structure. The second tool helps you build a broader thesis for why a currency should strengthen or weaken in the first place. One is a master of tactics, the other a master of strategy. For a trader, the real power doesn't come from choosing one over the other. It comes from understanding that they are two different, incredibly powerful lenses to view the same market. You can use the narrative analyst to identify a currency pair with a strong fundamental tailwind, say, a positive shift in economic news and central bank sentiment. Then you can switch over to the automated chartist to pinpoint a low-risk, high-probability entry point based on a clear technical setup. The AI isn't just one tool. It's a whole new toolkit. But this raises a critical question. With all this information, automated trend lines, sentiment scores, historical event analysis, how do you avoid being completely overwhelmed? Having powerful tools is one thing. Forging them into a coherent trading system, a workflow that actually helps you make better decisions without causing analysis paralysis, is another beast entirely. How do you prevent yourself from getting lost in the data? And how do you combine these different AI insights into a single cohesive trade idea? That's the critical next step, and that's where we're going next. So, you have a sentiment analysis tool telling you the market is feeling bullish about the euro. At the same time, you have a pattern recognition AI screaming that a bearish head and shoulders pattern is forming on the euro to US dollar hourly chart. And to top it all off, a third quantitative tool is flagging that historical volatility is at an all-time low, suggesting a massive breakout is imminent, but it won't tell you in which direction. What do? This isn't a hypothetical. This is the daily reality of using multiple powerful AI tools. Each one is a brilliant specialist, a virtuoso in its own right. But if you let them all play their own tune at once, you don't get a symphony, you get noise. And noise leads to hesitation. Hesitation leads to missed opportunities or, even worse, bad decisions. The secret isn't to find one magic AI that does everything. That doesn't exist. The secret is to become the conductor of this AI orchestra. You need a framework, a system for layering these insights on top of each other, so they either build a powerful unified case for a trade, or they cancel each other out, telling you to stay flat and preserve your capital. Let's call this framework the AI confluence funnel. Think of it as a filtering process, moving from the big, broad picture down to the sharp, specific details of a potential trade. At the very top of this funnel, the widest part is the macro sentiment layer. This is your 30,000-foot view of the market. Here you're using AI tools that scan the entire digital universe, news articles, central bank statements, economic reports, even the chaotic chatter of social media. The goal here isn't to find a specific entry or exit point. The goal is to establish a directional bias. Is the overwhelming narrative for the US dollar positive or negative right now? Is there an undercurrent of fear or greed developing around the Japanese yen? An AI sentiment tool can process millions of data points in seconds to give you a simple, digestible score. Strongly bullish, bearish, neutral. This is your starting point. It's the tide. You don't want to be trying to swim against a powerful tide unless you have a very, very good reason. So, you establish your bias. Let's say the AI sentiment analysis points to a strong bullish bias for the Australian dollar due to unexpectedly positive employment data and rising commodity prices. Great. That's the first piece of the puzzle. We're looking for reasons to buy the Aussie, not to sell it. Now we move down to the second layer of the funnel, the technical confirmation layer. This is where we take our macro bias and see if the charts agree. We deploy our AI technical analysis tools, the pattern recognizers, the support and resistance mappers, the intelligent indicator systems. If our macro bias is bullish for the Aussie, we are now actively looking for bullish technical signals. Is the AI identifying an ascending triangle on the Australian dollar to US dollar chart? Has it plotted a key Fibonacci retracement level that's holding a strong support? Is an AI-optimized moving average system signaling a fresh buy crossover? This is the critical test. If the sentiment is bullish but the charts are screaming bearish, with descending trend lines and bearish divergence flagged by your AI, then you have a conflict. There is no confluence. And in the world of trading, a lack of confluence is a clear signal to stand aside. The orchestra is out of tune. But if the technicals align with the sentiment, if you see that bullish sentiment backed up by a beautiful inverted head and shoulders pattern that your AI just flagged, now you have something powerful. The narrative and the price action are telling the same story. This brings us to the narrowest, most potent part of the funnel, the quantitative validation layer. This is where we get razor sharp. We've established a bullish bias and we have technical confirmation. Now we ask the heavy-duty quantitative AI, what are the probabilities? We use tools that analyze historical price action, volatility, and correlations to give us a statistical edge. For our bullish Australian dollar to US dollar setup, a quantitative AI might analyze the last 50 times a similar sentiment and technical pattern occurred. It could then output a probability score, for instance. Based on historical precedents, there is a 68% probability of a 75-pip upward move within the next 12 trading hours. It might also provide data-driven suggestions for stop-loss placement based on the average true range, or project a potential profit target where historical resistance is strongest. This layer doesn't predict the future. Let's be absolutely clear about that. What it does is take your trade idea, which is already supported by sentiment and technicals, and it stress tests it against the past. It answers the question, is this a historically high probability setup? Let's walk through a concrete case study. Imagine the Bank of England is scheduled to make an interest rate announcement. An hour before the announcement, you fire up your AI confluence funnel for the pound sterling to US dollar pair. Top of the funnel, your sentiment AI is scanning live news feeds and analyst chatter. It detects a growing consensus that the bank will be more hawkish than expected, meaning they'll sound aggressive about fighting inflation. The sentiment score for the British pound flips from neutral to moderately bullish. Your directional bias is now up. Middle of the funnel. You turn to your AI charting platform. It's been monitoring the pound sterling to US dollar 1-hour chart, and it identifies a bullish consolidation pattern, a rectangle that has been forming over the past few hours. It also highlights that the price is sitting directly on top of a dynamic support level generated by its algorithm. The technicals are aligning with your bullish bias. The setup looks promising. Bottom of the funnel. Now for the quantitative check. You consult your predictive analytics tool. You input the parameters, hawkish BOE surprise, and bullish consolidation pattern. The AI scours its database of historical price action. It comes back with a report. In 7 out of the last 9 similar instances, pound sterling to US dollar rallied by at least 100 pips in the 4 hours following the announcement. It calculates the current market volatility and suggests an optimal stop-loss placement 40 pips below the current price to avoid getting stopped out by initial noise. Look at what you have now. You have a trade idea that isn't just a gut feeling. It's a thesis, supported by 3 distinct layers of AI-driven analysis. The market narrative says up, the chart says up, and historical data suggests a high probability of up. This is the symphony playing in harmony. You've transformed a cacophony of data into a single, cohesive, high-probability trade idea. You've moved from analysis paralysis to decisive clarity. But here's the most important part of this entire process, the part that separates a successful trader from a failed one. The AI Confluence funnel produces a trade idea. It does not produce a command. You are the trader. You are the one who presses the button. This human-in-the-loop principle is non-negotiable. The AI doesn't know your personal financial situation. It doesn't know your risk tolerance. It doesn't know that you had a bad night's sleep and might be more prone to making emotional mistakes. The AI provides the data. You provide the wisdom and the ultimate judgment. Your role as the conductor is to listen to your orchestra, but you are the one who makes the final decision on how the music is played. You might see this perfect setup, but decide the potential risk is still outside your personal comfort zone, so you pass. And that is a perfectly valid and often very wise decision. So we've built this robust framework for generating trade ideas, moving from a broad market theme down to a statistically backed entry plan. But generating the idea is only half the battle. Once you're in a trade, a whole new set of challenges emerges. How do you manage the position? How can AI help you decide when to take profits, when to move your stop-loss to break even, or when to cut a trade that's starting to turn against you? Because in the fast-moving world of Forex, your entry is just the beginning of the story. Managing the trade effectively is where consistent performance is truly forged. And that's exactly where we're headed next. Into the world of AI-assisted trade and risk management. Once you're in a trade, the market doesn't care about your analysis, your strategy, or how confident you were when you clicked the buy button. The moment you're live, you enter a new arena. It's an arena governed by 2 of the most powerful and destructive forces in human psychology: fear and greed. This is the world of trade management, and it's where most trading journeys either flourish or fail. Think of it like this. An airline pilot might spend hours meticulously planning a flight path, checking the weather, and running pre-flight diagnostics. That's the analysis, the entry setup. But all that planning means nothing if they can't navigate the sudden violent thunderstorm that appears over the mountains. The entry is the takeoff. The trade management is flying the plane through the storm. For decades, traders have tried to build rigid systems to combat their own emotions. I will always place my stop-loss 20 pips away. I will always take profit at a 2-to-1 risk-reward ratio. These rules are born from a noble desire for discipline, an attempt to build a fortress against the emotional chaos of a fluctuating P&L. But the market is not a rigid, linear system. It's a living, breathing entity. It's dynamic. A 20-pip stop-loss that was perfectly reasonable in a quiet market might be statistical noise during a high-volatility news release. A fixed take-profit target might get hit, only for you to watch the price continue to soar for another 200 pips, leaving you with a painful case of what if. This is the precise problem that AI-assisted trade and risk management tools are designed to solve. They don't offer a magic wand. Instead, they offer something far more valuable: dynamic, data-driven discipline. They serve as the unemotional co-pilot, constantly scanning the instruments, calculating probabilities, and offering guidance based on pure logic. not on the adrenaline rush of a winning streak or the cold panic of a drawdown. They don't get greedy. They don't get scared. They just compute. Let's start with the absolute bedrock of survival in trading: the stop loss. A traditional approach, like placing a stop below the most recent swing low, is a sound principle. It's logical, but an AI can elevate this to an entirely new level. Instead of just seeing a single swing low on one chart, an AI can process multiple dimensions of information simultaneously. It can analyze the current market volatility using metrics like the average true range, or ATR. If the market is choppy and volatile, the AI might suggest a wider stop loss, understanding that the price needs more room to breathe to avoid being prematurely stopped out by random noise. Conversely, in a quiet, tight-ranging market, it might recommend a much tighter stop to protect capital and improve the risk-to-reward ratio. Goes even deeper. An AI can analyze market structure across multiple time frames. It might see that the swing low on your 15-minute chart is just minor noise, but a level 30 pips lower represents a major structural support zone on the 4-hour chart, a historical pivot point, and the confluence of a key Fibonacci level. It can then calculate that placing a stop loss just below that multidimensional zone has a historically higher probability of holding than the simple, obvious low everyone else is watching. The AI is essentially finding the fortress wall, not just the flimsy fence to put behind your position. Now let's flip the coin and talk about take profits. This is where greed so often sabotages a perfectly good trade. How many times has a trader been in a profitable position, only to hold on for just a little more, watching it reverse and turn into a loss? The AI solution is, again, dynamic logic. Instead of a fixed target, it scans the path ahead for obstacles. It identifies significant areas of supply and demand, key resistance levels, and pivot points where institutional order flow is likely to be concentrated. It can project Fibonacci extensions to identify areas where trends have historically tended to exhaust themselves. The AI might present you with multiple potential take-profit levels, each with an associated probability. Target 1 has an 80% probability of being hit, based on current momentum, while Target 2 has a 45% probability, but offers a much higher reward. This transforms profit-taking from an emotional guess into a strategic, probability-based decision. But perhaps the most powerful application of AI in trade management is the evolution of the trailing stop. The mantra, "cut your losers short and let your winners run," is the holy grail of trading. A standard trailing stop, which moves up a fixed amount as the price moves in your favor, is a step in that direction. But it's a clumsy instrument. It's like trying to follow a dancer by taking 1-meter steps at a time. You'll either be too far away or you'll trip over them. An AI-powered trailing stop, however, moves with the rhythm of the market itself. It doesn't use a fixed distance. It might use a dynamic moving average that adapts its length based on market momentum. Or it might trail the price based on the underlying volatility, giving it more space during aggressive moves and tightening up during consolidations. One of the most sophisticated approaches is a structural trail. The AI identifies the market structure in real time. As the price makes a new high and then pulls back to form a new higher low, the AI intelligently moves the stop loss just below that new structural point. This allows you to stay in a trend through all its natural ebbs and flows, capturing the lion's share of the move, only taking you out of the trade when the market structure itself shows signs of breaking down. It's the difference between getting shaken off a bucking horse and being a master equestrian who moves with the animal. This micro-level, single-trade management is incredible, but the real paradigm shift comes when AI is applied to macro-level risk management across your entire portfolio. This is where it starts to function less like a co-pilot and more like an entire risk management department working for you 24/7. The first and most crucial element here is position sizing. Most traders learn a simple rule: risk no more than 1% or 2% of your account on any single trade. It's a great rule, but it's a blunt instrument. An AI can refine this with surgical precision. Let's say you want to risk 1% on a trade. The AI won't just calculate the lot size based on a simple stop distance. It will factor in the specific currency pair's historical and current volatility. A 1% risk on a typically stable pair like euro to Swiss franc should result in a different position size than a 1% risk on a notoriously volatile pair like pound sterling to Japanese yen. The AI can also assess the quality of the trade setup itself. Using machine learning, it can compare the current setup to thousands of historical examples. If it identifies a setup with a very high historical win probability, it might suggest allocating a slightly larger position size within your risk tolerance. For a lower probability setup, it would suggest a smaller size. This is called risk weighting, and it's something professional quantitative funds do every single day. Beyond that, the AI can be your ultimate defense against one of the most hidden dangers in Forex: correlation. You might think you're diversified because you have 3 different trades open. You're long the euro to US dollar, long the pound sterling to US dollar, and short the US dollar to Swiss franc. You feel safe. But an AI, by constantly monitoring a real-time correlation matrix, would immediately flash a warning. It would see that because all 3 positions are essentially a bet against the US dollar, they are highly correlated. You don't have 3 separate trades. You have one giant, triple-leveraged bet against the dollar. If a positive US economic report comes out, all 3 of your positions could be wiped out simultaneously. The AI acts as your portfolio's guardian, alerting you to these hidden concentrations of risk and allowing you to manage your exposure before disaster strikes. Let's imagine a trader, we'll call him Alex, using one of these AI assistants. The system flags a potential short on US dollar to Canadian dollar based on a confluence of factors. Alex agrees with the analysis. He decides to risk 1% of his capital. The AI instantly analyzes the current volatility of US dollar to Canadian dollar, identifies a structurally sound stop-loss level above a key resistance zone, and calculates the exact lot size to ensure his risk is precisely 1%. No more, no less. The trade is placed. The price begins to fall, moving in Alex's favor. The AI's dynamic trailing stop engages, moving the stop-loss down not by a fixed number of pips, but just above each newly formed lower high, locking in profits while giving the trend room to develop. Then, an unexpected OPEC announcement hits the wires. Crude oil prices spike, which has a massive impact on the Canadian dollar. Volatility in US dollar to Canadian dollar explodes. Alex's phone buzzes. It's an alert from his AI assistant. Extreme volatility detected. Current trailing stop may be too tight for market conditions. Suggests widening trail to structural resistance or reducing position size to mitigate news-driven risk. Alex, seeing the logic, manually adjusts his stop to the more conservative level the AI suggested. The price whipsaws violently for the next few minutes, taking out traders with tight, fixed stops, but Alex's position, protected by the wider, structurally aware stop, survives the noise. The trend then resumes its downward path, and he ends up capturing a much larger move. The AI didn't predict the news, but it provided the framework to manage the risk associated with it in a logical, unemotional way. This is the future of responsible trading. It's not about outsourcing your thinking. It's about augmenting your intuition and analysis with the tireless data-driven power of a machine. It's a system that helps you manage not just the trade, but helps you manage yourself, protecting you from your own worst enemies: fear and greed. It turns risk management from a static checklist into a living, breathing system that adapts and responds to the ever-changing personality of the market. So we've seen how AI can help us find the trade, and how it can manage the trade with robotic discipline. But what happens when we let the machine take the wheel entirely? In the next part, we're diving deep into the controversial and fascinating world of fully automated AI trading bots. Can they truly trade better than a human? We're about to find out. So, can they truly trade better than a human? The answer is one of the most fiercely debated topics in modern finance. It's a land of incredible potential and spectacular failures. Welcome to the world of fully autonomous AI trading bots. Let's get one thing clear right away. We're not talking about the simple rule-based expert advisors, or EAs that have been around for years. Those are like a basic calculator. You program it with a rule like, if this moving average crosses that moving average, then buy. It's rigid. It's dumb. Follows instructions and nothing more. If the market context changes, the calculator doesn't know. It just keeps calculating, often leading to a string of losses because the old rules no longer apply. What we're talking about is a different species entirely. A true AI trading bot is more like a self-driving car. It doesn't just follow a pre-programmed route. It has sensors, it processes a live feed of the world around it. It learns from every mile it drives, and it makes decisions in real time to navigate traffic, avoid obstacles, and reach its destination. The sensors for an AI trading bot are its data feeds. And it's not just looking at price charts. It's consuming everything. It's reading every central bank statement, every earnings report, every political headline from a dozen countries, in multiple languages, the second they're published. It's analyzing social media sentiment to gauge market fear or greed. Some advanced systems even process satellite data, counting cars in retail parking lots to predict consumer spending, or tracking the movement of oil tankers to forecast supply. It's building a multidimensional picture of the global economy that is utterly impossible for a human brain to comprehend all at once. And then there's the brain. This is where the magic and the danger lies. At the heart of these bots are sophisticated machine learning models, often using a technique called reinforcement learning. Imagine teaching a dog a new trick. When it does the trick correctly, you give it a treat. When it fails, it gets nothing. Over time, the dog learns which actions lead to a reward. Reinforcement learning for an AI trading bot is that same concept, but on an epic scale. The AI is placed in a simulated market environment with years of historical data. It makes a trade. If the trade is profitable, it gets a digital treat, a positive score. If it loses money, it gets a penalty. Now, imagine it doing this not once but millions, even billions of times. It runs through every conceivable market scenario from the past, crashes, booms, quiet periods, trying every possible strategy. It learns through brutal trial and error what combination of actions tends to lead to the highest score over time. It's not just learning a simple rule. It's developing an intuition, a machine-based intuition, for the flow of the market. This is what makes them so seductive. First, there's the complete removal of emotion. Human traders are their own worst enemy. We feel fear when a position goes against us and we sell at the bottom. We feel greed when a position is winning, and we hold on too long, only to watch our profits evaporate. We feel the fear of missing out and jump into a trade without proper analysis. The AI feels nothing. It doesn't care if the market is crashing. It doesn't get excited during a rally. It simply executes the strategy that its billion simulated trials have determined to be the most statistically probable path to a positive outcome. Second, they operate 24/7. The Forex market is a global beast that never sleeps. While a human trader in New York is asleep, massive moves can happen during the Tokyo or London sessions. The bot is always awake, always watching, ready to act on an opportunity at 3 a.m., just as it would at 3 p.m. And third, there's the speed. An AI can analyze dozens of data points and execute a trade in a fraction of a millisecond. By the time a human trader has even registered a price movement on their screen and moved their mouse to click buy, the AI has already entered and potentially exited the same trade. So, with these incredible advantages, why hasn't everyone just handed their money over to an AI bot and retired to a beach? Because for every story of success, there's a cautionary tale of catastrophic failure. The biggest demon these systems face is a problem called overfitting. Think of it like a student who crams for a history test by memorizing the exact questions and answers from last year's exam. On that specific test, they get a perfect score. They look like a genius. But the moment the teacher gives them a new test with slightly different questions, they are completely lost. They didn't learn the actual history. They just memorized a specific dataset. An overfitted AI bot has done the same thing. It has become so perfectly optimized to trade on past data that it's brittle. The moment the live market behaves in a way that is even slightly different from what it has seen before, its entire logic can shatter. It sees a pattern that looks familiar, but the context is new, and it applies an old solution to a new problem, often with disastrous results. Then there's the black box problem. With the most complex AIs like deep neural networks, even their creators often don't know exactly why the bot made a particular decision. The web of calculations is so intricate, so layered, that it's impossible to trace the logic. Was it a valid insight, a flicker of machine genius? Or was it acting on a random flawed correlation it found in the data, like thinking that a rise in soybean futures in Brazil is somehow predictive of the euro/yen exchange rate? When it's working, it feels like magic. When it's not, it's a terrifying mystery. This is especially true during black swan events, unprecedented moments that have no historical parallel. The bot is trained on the past. It has no data for a global pandemic shutting down the world economy, or a sudden unexpected geopolitical conflict. In these moments of extreme chaos, human traders can fall back on intuition, common sense, and a broad understanding of how the world works. The AI has no such anchor. It only has its data, and when that data becomes irrelevant, the AI is flying blind. We saw glimpses of this during events like the 2010 flash crash, where automated systems chasing each other's tails caused a trillion-dollar stock market plunge in minutes. Let's imagine a scenario. We have a skilled human trader, we'll call her Clara. She's been trading for 15 years. She's up against Nexus 7, a state-of-the-art AI bot. 4 weeks, Nexus 7 runs circles around her. It's scalping tiny profits hundreds of times a day, with flawless, emotionless precision. Its equity curve is a beautiful, smooth line upwards. Clara, meanwhile, is taking a few careful, well-analyzed trades a day. She's profitable, but she can't compete with the machine's volume and consistency. Then one Tuesday morning, an unexpected announcement comes out. A major central bank makes a surprise policy shift that no one saw coming. The markets are thrown into chaos. Volatility spikes. Nexus 7, the AI, sees patterns that resemble previous periods of high volatility. It starts executing its pre-programmed strategy for that environment, buying dips and selling rips. But this time is different. The fundamental context of the market has changed. The old patterns are a trap. Nexus 7 starts taking loss after loss, unable to comprehend that the rulebook it learned from has just been thrown out the window. Clara, on the other hand, sees the news and immediately understands its implications. She draws on her years of experience, her understanding of macroeconomics, and her human intuition. She recognizes that this isn't just noise, it's a seismic shift. She closes her position, stays out of the initial chaos, and then once the dust settles, she identifies a new powerful trend born from the event, placing a single well-timed trade that capitalizes on the new market reality. By the end of the day, Nexus 7 has given back all of its profits from the previous month. Clara has had her best trading day of the year. This story isn't to say that humans are definitively better. It's to illustrate that the strengths of the AI are also its greatest weaknesses. Its rigid logic, its reliance on the past, its lack of genuine comprehension. It's a powerful tool, but a flawed master. The dream of a set-it-and-forget-it money machine remains for most just a dream. The risk of handing over complete control is simply too great. So, if a fully autonomous AI is a double-edged sword, and manual trading has its human limitations, where is the middle ground? How do we combine the raw computational power of AI with the nuanced intuition of a human expert? That's the holy grail we're chasing. And in the next part, we're going to explore the rise of AI-powered co-pilots and hybrid trading systems that aim to give traders the best of both worlds. So let's talk about that middle ground. This isn't about handing over the keys to a machine and hoping for the best. It's about building the ultimate partnership. Think of it less like an autonomous self-driving car, and more like the most advanced co-pilot you could ever imagine sitting next to you in the cockpit. This is the world of hybrid trading systems, where artificial intelligence doesn't replace the trader, it empowers them. The core idea is simple but profoundly powerful. Augment human intelligence, don't automate it away. A human trader, no matter how experienced, has limitations. We can only watch so many charts at once. We can only process so much news. We get tired, we get emotional, we fall into cognitive biases like confirmation bias, where we only see data that supports what we already believe. A fully automated system, on the other hand, has its own set of blind spots. It has no true understanding of a sudden geopolitical crisis beyond what its historical data suggests. It can't read the subtle, nuanced language of a central bank governor and grasp the underlying sentiment. It operates in a world of pure data, which can sometimes be a world devoid of context. The hybrid model, this AI co-pilot, is designed to bridge that gap. It aims to take the best of machine processing power and marry it with the best of human intuition and contextual awareness. So how does this actually work in practice? Let's break it down. First, and most fundamentally, these systems act as an unparalleled information filter. The Forex market is a relentless fire hose of information. Economic data releases, political speeches, thousands of news articles, social media sentiment, and of course the price action across dozens of currency pairs. It's impossible for one person to track it all. An AI co-pilot, however, can ingest and analyze this entire ocean of data in real time. But it doesn't just dump it on your screen. That would be useless. Instead, it synthesizes it. Using natural language processing, it can scan 10,000 news articles about the Eurozone and give you a single digestible summary. Market sentiment for the euro is currently 65% bullish, driven by stronger than expected German manufacturing data, but tempered by cautious remarks from the ECB. You didn't have to read a single article. The AI did the legwork and gave you the conclusion. Second, these tools are masters of pattern recognition at a scale we can't comprehend. As a trader, you might have a few favorite technical patterns you look for: a head and shoulders, a bullish flag, a double bottom. You might scan a handful of your favorite currency pairs looking for these setups. An AI co-pilot can scan every single currency pair on every single time frame, from the 1 minute to the monthly chart 24 hours a day, looking for the exact technical criteria that you've defined. It never blinks. It never gets bored. And when it finds a potential match, it doesn't execute a trade. It simply alerts you. It's like having an army of junior analysts who work for free, and their only job is to tap you on the shoulder and say, hey, you might want to take a look at the pound sterling to Japanese yen 4-hour chart. It's starting to form that reversal pattern you like. The final decision to analyze it further and act on it is still yours. Third is the concept of enhanced risk management. This is one of the most practical and valuable applications. Many traders struggle with consistently applying their own risk rules, especially in the heat of the moment. An AI co-pilot can act as your disciplined, unemotional partner. Before you enter a trade, you can input your entry, stop loss, and take profit levels. The AI can instantly calculate the optimal position size based on your predefined risk tolerance. Say, no more than 1% of your account balance per trade. It can also flag a trade if it falls outside your normal parameters. Imagine you're about to place a trade out of frustration, a revenge trade, and your AI assistant flashes a warning. This trade's risk-to-reward ratio is 1 to 0.5, which is below your minimum requirement of 1 to 2. Are you sure you want to proceed? That simple, data-driven interruption can be the critical circuit breaker that saves a trader from making a costly emotional mistake. Beyond these core functions, we're seeing the emergence of even more sophisticated capabilities. Some AI co-pilots offer real-time scenario simulation. You see a potential setup and you're curious. You can ask the AI to run a simulation based on the last 10 years of market data. How has this specific setup on this currency pair performed historically under similar volatility conditions? Within seconds, it can come back with a detailed report showing historical win rates, average gains, and maximum drawdowns for that exact type of trade. This isn't a crystal ball predicting the future. It's a powerful tool for understanding historical probabilities, which can add a significant layer of data-driven confidence or caution to your trading decisions. The beauty of this human-in-the-loop system is that it preserves the trader's most valuable asset, their experience. The AI handles the heavy lifting of data processing and scanning, freeing up the trader's mental capital to focus on higher-level strategic thinking. The trader is no longer a data entry clerk or a chart scanner. They are elevated to the role of a strategist, a decision-maker. The AI presents the what, the data, the patterns, the probabilities. The human provides the why, the contextual understanding, the nuanced interpretation, the final go or no-go decision. For example, an AI might flag a perfect technical buy signal on the US dollar. But a seasoned trader might know that the Federal Reserve Chairman is speaking in an hour and has a history of making dovish statements that weaken the dollar. The trader can look at the AI's data-driven suggestion and say, "Thank you for the signal, but I'm going to wait." The qualitative context here outweighs the quantitative signal for the next hour. That's the partnership. That's the synergy. The AI provides the objective analysis, and the human provides the subjective wisdom. This approach also has profound psychological benefits. It can help mitigate the two great enemies of the trader, fear and greed. The fear of missing out, or FOMO, is reduced because you know your AI co-pilot is constantly scanning the markets for you. You don't have to be glued to your screen 12 hours a day, terrified you'll miss the one big move. Greed can be kept in check by the AI's disciplined risk management reminders, preventing you from over-leveraging on a trade that feels like a sure thing. It introduces a layer of objective, unemotional discipline into a process that is often fraught with emotion. Of course, it's crucial to understand that these co-pilots are not a panacea. The system is only as good as the strategy and parameters defined by the user. If you program the AI with a fundamentally flawed trading strategy, it will simply become a highly efficient tool for finding bad trades. The garbage in, garbage out principle applies more than ever. There's also the risk of over-reliance, where a trader starts to blindly trust the AI's suggestions without doing their own critical analysis. The tool is meant to be a co-pilot, not the pilot in command. The moment the human stops thinking and questioning is the moment this powerful partnership breaks down. Ultimately, the rise of these hybrid systems represents a maturation in our relationship with AI and finance. We're moving beyond the simplistic, binary debate of human versus machine. We're entering a new era of human plus machine. The goal is not to create an infallible oracle that prints money. The goal is to build the most advanced dashboard imaginable, one that filters out the noise, highlights opportunities, and enforces discipline, allowing the human trader to make better, more informed, and less emotional decisions. It's about taking the art of trading and backing it up with an unprecedented level of science. But this raises a critical multi-million-dollar question. With all this sophisticated technology, how do we actually know if it's working? How can you test an AI strategy without blowing up a real account? The process of backtesting and validating an AI trading model is a minefield of potential pitfalls and statistical traps that can easily mislead even savvy traders. And navigating that minefield is exactly what we're going to tackle next. The first and perhaps most seductive trap is a concept called overfitting. Imagine you're training a new employee for a very specific task. You give them a set of 10 problems from last year, and you drill them on those exact 10 problems day in and day out. They memorize the questions, the steps, the exact answers. After a week, you test them on those same 10 problems, and they score a perfect 100%. You're thrilled. You think you've found a genius. But then, on their first day on the job, a new, slightly different problem comes in, and they're completely lost. They freeze. They have no idea how to solve it because they didn't learn the underlying principles. They just memorized the past. An AI model is that new employee. The historical data you feed it is that set of 10 problems. Overfitting is what happens when the AI, in its quest to please you and find the most profitable path through that historical data, becomes a master memorizer instead of a master strategist. It doesn't learn the fundamental dynamics of the market, the ebb and flow of supply and demand, the impact of sentiment. Instead, it learns the noise. It finds bizarre, coincidental correlations that existed only in that specific slice of history. It might learn that every time the euro to US dollar pair wiggled in a specific way on the third Tuesday of the month, it was followed by a massive rally. It treats this coincidence as a holy grail, a law of the market. But it wasn't a law. It was just random chance, a ghost in the machine of the past. When you unleash this overfitted model on the live market, it's seeing new problems for the first time. The old, memorized answers don't work, and the model starts making trades based on phantom patterns, leading to a slow, or sometimes very fast, bleed of your capital. It's the single biggest reason why 9 out of 10 unbelievably profitable backtests fail in the real world. The second pitfall is more subtle, a silent assassin of trading models. Look-ahead bias. This is an error in how you design your test, and it's incredibly easy to make. Look-ahead bias happens when your backtesting model is accidentally given information that it wouldn't have had in a real-time trading scenario. It's like letting your model cheat on the test. Imagine trying to predict the outcome of yesterday's Super Bowl. If you already know the final score, it's pretty easy to build a model that perfectly predicts the winner, right? You could say, my model predicts the team that scores more than 30 points will win, and it would be 100% accurate. But that's not a prediction. It's a description of the past using information that was only available at the end of the game. In Forex trading, this happens in countless ways. A common mistake is using the day's high or low price to make a decision. For example, your AI's rule might be, if the price breaks above 75% of today's daily range, go long. In a backtest, this might look fantastic. But think about it. At 10 in the morning, how do you know what the high for the entire day is going to be? You don't. The final high and low for the day aren't known until the day is over. By using that data in your backtest for a decision made midday, you've given your AI a crystal ball. You've allowed it to peek at the future. The only way to combat this is with meticulous test design, ensuring that at any given point in your simulation, the AI only has access to the exact same information a live trader would have at that precise moment in time. The third, and most human, pitfall is data snooping, also known as curve fitting. This is the act of endlessly tweaking and optimizing your model on the same set of historical data until it produces a beautiful, upward-sloping equity curve. It's the researcher's temptation. You run a backtest and it's okay but not great. So you think, what if I change this moving average from 20 periods to 22? The result gets a little better. Okay, what if I add this other indicator but only on Fridays? Gets better again. You keep adjusting, keep tweaking, keep layering on rules, running dozens, even hundreds of variations. Finally, you find the magic combination of parameters that turns a mediocre strategy into a world beater on your historical chart. You lean back, convinced you've cracked the code. But you haven't. All you've done is torture the data until it confessed. You've found the one specific set of rules that perfectly fit the random noise of that particular historical period. You haven't discovered a robust market edge. You've just created a masterpiece of hindsight. This model is incredibly fragile, a house of cards built on coincidence. The moment market conditions shift even slightly, the entire structure will collapse. So, how do we escape this minefield? How do we build and test an AI model that has a fighting chance in the chaos of the live markets? The answer lies in a disciplined, rigorous validation framework, one that professional quantitative funds use every single day. The first, most critical step is to split your data. Before you do anything else, you take your entire history of market data and divide it into at least two parts. The larger part, maybe the first 70% of the data, is your in-sample or training data. This is your sandbox. This is the only data you are allowed to use to build, train, and optimize your model. You can do your data snooping here, you can test 1,000 variations, you can curve fit to your heart's content. But the remaining 30% of the data, you lock it away in a virtual vault. This is your out-of-sample or validation data. Your model has never seen it. It has no idea what patterns, crashes, or rallies occurred during this period. After you've finalized your model based on the training data, once you've decided, this is it, these are the final rules, you then unleash it one time and one time only on the out-of-sample data. This is the final exam. This is the moment of truth. If your model performs nearly as well on this unseen data as it did on the training data, you may have found something robust. But if you see a dramatic drop-off in performance, if that beautiful equity curve suddenly nosedives, you know your model was overfitted. It memorized the past but learned nothing about the future. It's a painful discovery, but finding it out in a simulation is infinitely better than finding it out with your real money. For an even higher level of confidence, we can use a technique called walk-forward analysis. Instead of a single split, walk-forward analysis treats time as it truly is, a continuous forward-moving stream. You break your data into, say, 10 chunks. You train your model on the first chunk, then you test it on the second. Then, you retrain your model on chunks 1 and 2 combined, and test it on chunk 3. You continue this process, walking forward through your data, constantly optimizing on the past and testing on the immediate future. This process more closely mimics how a real trading system would have to adapt over time. It tests whether the model's core logic is durable enough to survive changing market regimes, from low volatility grinds to high volatility panics. Finally, to test the system's fragility, we can use a powerful statistical method called a Monte Carlo simulation. Once you have your backtest results, a sequence of trades, some wins, some losses, the Monte Carlo analysis comes in and essentially asks, what if? It scrambles the order of your trades thousands of times to see if your amazing results were just because you had a few massive winners right at the beginning. A robust system's overall profitability shouldn't be entirely dependent on the lucky sequence of its trades. The simulation can also introduce small random variations. What if your slippage was slightly worse on some trades? What if you missed a few entries? It runs thousands of these slightly altered equity curve scenarios. The result isn't one single performance line, but a cloud of potential outcomes. This allows you to see the statistical probability of different results and helps you understand if your backtest was a fluke or if it points to a genuine, persistent market edge. This entire process, from avoiding overfitting and look-ahead bias to using out-of-sample data and Monte Carlo simulations, isn't about finding a model that looks perfect on a historical chart. It's about forensics. It's about being a detective, stress-testing your creation, and trying with all your might to prove it wrong. Because only by aggressively searching for its flaws in the past can you gain any measure of confidence in its potential for the future. But once you have this validated data, how do you even read it? A final profit number tells you almost nothing. To truly understand the personality and risk of an AI trading model, you need to look deeper, at a specific set of metrics that reveal its true character. And dissecting those crucial performance metrics is precisely where we're headed next. So let's pull back the curtain. The first metric most people see, and the one that's most misleading, is the simple win rate. An AI with a 90% win rate sounds incredible, right? It sounds like a money printing machine. But what if those 9 wins each made you $10, and that one single loss cost you $200? You'd be down $110, despite winning 90% of the time. The win rate in isolation is a vanity metric. Feels good, but it tells you almost nothing about profitability. That's why the first metric you should actually look for is the profit factor. This is a much more honest number. It's calculated by taking the total money made on all winning trades and dividing it by the total money lost on all losing trades. It's that simple. A profit factor of 1 means you broke even. Anything below 1, and the system is historically unprofitable. A profit factor of 2 means that for every dollar the AI model lost, it historically made $2. It's a direct measure of profitability that cuts through the noise of a simple win rate. It immediately tells you if the gains are outweighing the losses over a given period. Think of it like a business's gross profit margin. It doesn't tell you the whole story, but it tells you if the core operation is fundamentally sound. So while a high win rate is nice, a strong profit factor is essential. But even a great profit factor can hide a terrifying secret. This brings us to the single most important metric for understanding an AI's risk profile: the maximum drawdown. This number represents the single largest drop from a peak in your account value to a subsequent low, before a new peak is achieved. In plain English, it's the worst losing streak the AI has ever had, measured in a percentage of the account. This isn't just a number, it's a measure of psychological pain. Imagine an AI has a fantastic track record, doubling an account over a year. But buried in that history is a maximum drawdown of 50%. That means at some point, to get that 100% gain, an account using this model was cut in half. It went from, say, $10,000 down to $5,000 before it started climbing back up. The critical question you have to ask yourself is, could I emotionally handle that? Could you watch your account get sliced in half and not pull the plug? Most people can't. They would have abandoned the system at a 30 or 40% loss, missing the entire recovery and subsequent gains. The maximum drawdown is the AI's personality under extreme stress. It reveals its capacity for deep, gut-wrenching slumps. A lower drawdown suggests a smoother, more consistent ride, while a high drawdown indicates a volatile, high-wire act. Understanding this number is non-negotiable because it determines whether you can actually stick with the system long enough to see its potential play out. Now let's get a bit more sophisticated. We know the potential for profit from the profit factor, and we know the potential for pain from the maximum drawdown. But how do we relate the two? How much reward are we getting for the amount of risk we're taking? That's where the Sharpe ratio comes in. This is a classic metric from institutional finance, and for good reason. It measures risk-adjusted return. It essentially asks, for every unit of volatility or bumpiness the AI's equity curve experiences, how much return are you getting? Think of it like this: you have two cars. Car A goes from 0 to 60 in 3 seconds, but the ride is violent, shaky, and feels like it could fall apart at any moment. Car B goes from 0 to 60 in 4 seconds, but the ride is smooth as glass. Car A has a higher absolute return, it's faster. But Car B has a better risk-adjusted return, a better Sharpe ratio. It delivers excellent performance without the stomach-churning volatility. In trading, a higher Sharpe ratio suggests a more efficient system. It's generating returns more smoothly, without as many wild swings in the account balance. It's a measure of quality, not just quantity of returns. And we can refine this even further with a close cousin of the Sharpe ratio, called the Sortino ratio. The Sortino ratio is clever. It recognizes that volatility isn't always a bad thing. When your account value is rocketing upwards, that's technically volatility, but it's good volatility. We like that. The Sortino ratio only punishes the AI for downside volatility, the bad kind, the kind that creates drawdowns. It ignores the upside swings. So, it asks an even more specific question. For every unit of harmful risk the AI takes, how much return is it generating? This gives you a cleaner picture of how well the system manages its losses. An AI with a high Sortino ratio is typically very good at protecting capital on the downside, which is a hallmark of a mature and robust trading model. Finally, we need to understand the AI's trading style, its very DNA. We do this by looking at the ratio of the average win to the average loss. This single metric reveals the core strategy. Is the AI a scalper, aiming for a huge number of tiny wins where the average win might be just $20 but the average loss is capped at 40? This would be a high win rate system that relies on its wins far outnumbering its losses. Or is the AI a trend follower, a home run hitter? This system might have a much lower win rate, maybe only 30 or 40%. But its average win might be $500, while its average loss is only $100. It strikes out a lot, but when it connects, it hits it out of the park. Neither strategy is inherently better than the other, but they require completely different mindsets from the user. The first strategy, the scalper, requires you to be comfortable with a system where any single loss can wipe out several previous wins. The second, the trend follower, requires you to be comfortable with long strings of small losses while you wait for that one massive portfolio-defining win. By understanding this ratio, you can see if the AI's personality matches your own. Are you a patient slugger or a nimble singles hitter? If there's a mismatch between the AI's strategy and your own emotional tolerance, you're setting yourself up for failure, because you'll inevitably intervene at the worst possible moment. These metrics, profit factor, maximum drawdown, Sharpe and Sortino ratios, and the average win/loss ratio are not just abstract data points. They are the diagnostic tools you use to build a complete psychological and performance profile of an AI model. They move you beyond the flashy marketing claims and into the realm of professional analysis. They form a mosaic where each tile gives you a different angle, a new piece of the puzzle. Together, they paint a picture of the AI's historical behavior, its temperament under pressure, and its fundamental approach to the market. But even with this complete picture, analyzing the AI is only half the battle. The final and most crucial step is figuring out how to take this powerful tool and integrate it into a real-world trading plan that works for you, a human. Because the best AI in the world is useless without a disciplined human operator at the controls. And building that human AI framework is the final piece of our puzzle. So let's build it right now. The first principle of a successful human AI framework is defining the roles. You are the CEO of your trading operation. The AI? It's your top analyst. It's the brilliant quant you just hired who can process 1 million data points before you've had your first sip of coffee. But you would never let a brand new analyst, no matter how smart, have the final say on multi-thousand-dollar decisions. You listen to their report, you weigh their analysis, but the executive order comes from you. Always. The moment you cede final authority to the algorithm, you're no longer a trader, you're a passenger. And in the world of finance, you never want to be just a passenger. So, how does the CEO-analyst relationship work in practice? It starts with a daily ritual, a pre-market briefing. But the first person you brief is yourself. Before you even look at a chart or run a single AI query, you perform a human check-in. What's the major economic news on the docket for today? Is there a Fed announcement? Non-farm payrolls? These are events that can throw even the most sophisticated algorithm for a loop because they're driven by human emotion and policy, not just historical price action. You, the human, understand the potential for chaos. The AI only understands the patterns of the past. Next, you check your own personal state. Did you sleep well? Are you stressed about something outside of trading? Are you feeling greedy after a big win yesterday? Or fearful after a loss? Be brutally honest. This internal gut check is a data point your AI can never provide. If you're not in the right headspace, you have two choices. Reduce your risk for the day or don't trade at all. Being the CEO means knowing when to bench your star player, which is you. Only after your human check-in is complete do you turn to your analyst, the AI. You don't just ask it, "What should I do?" That's lazy and dangerous. You give it specific tasks. Run a sentiment analysis on the euro to US dollar for the London session. Identify the top 3 currency pairs showing statistically significant momentum, according to our backtested parameters. What does the probabilistic model suggest for volatility over the next 4 hours? You are requesting specific reports, gathering intelligence. Now comes the most important step, the confluence protocol. This is where the magic happens. You take your human analysis, your understanding of the macro environment and your own risk appetite, and you lay it next to the AI's data-driven reports. You are looking for one thing, agreement. Confluence. Let's imagine your human analysis tells you that the market is nervous ahead of an inflation report, suggesting a risk-off sentiment might favor the US dollar. You then look at your AI's report, and it has flagged a high probability short signal on the Australian dollar to US dollar, citing weakening momentum and negative sentiment metrics. Boom! That's confluence. The human narrative and the machine's data are telling the same story. This is a high-potential setup. But what if your human analysis suggests a risk-off day? But the AI is flagging a strong buy signal on a typically risky pair like pound sterling to Japanese yen. This is a divergence. A red flag. In the confluence protocol, divergence means you do nothing. You sit on your hands. You trust the disagreement. The CEO doesn't proceed when their top advisors are in conflict. The absence of a trade is very often the best trade you can make. This single discipline, acting only on confluence and standing aside during divergence, can be a fundamental factor in managing risk. Once you take a trade based on confluence, your job still isn't over. This is where most people fail. They close the trade, look at the profit or loss, and move on. The CEO, however, demands a postmortem. You must journal every single trade, but not just the numbers. You document your reasoning. Human rationale. Expected risk-off sentiment. AI rationale. Provided a 72% probability short signal based on momentum decay. Confluence was strong. Entry was executed per the plan. Then, crucially, you document the outcome and reflect. If the trade was a winner, was it a good decision? Or did you just get lucky? If it was a loser, was it a bad decision? Or was it a good, well-reasoned decision that simply didn't work out this time? This process of journaling your human AI decisions is how you refine the system. Maybe you notice that your AI signals are less reliable during major news events. Great! You've just learned a new rule for your framework. Reduce reliance on the AI in the 30 minutes before and after a red folder news release. Or maybe you notice your own fear causes you to exit confluent trades too early. That's an insight into your psychology that you need to work on. The framework isn't just about managing the AI. It's about using the AI to better manage yourself. Now we have to talk about the traps. The first is the automation trap. It's the seductive idea that you can find the perfect AI, set it to auto, and go live on a beach. This is a fantasy. Markets are dynamic, adaptive systems. A strategy that works today might fail tomorrow because the underlying market behavior has changed. A surprise geopolitical event can render a decade of back-tested data irrelevant in a single afternoon. You, the human CEO, must always be there to supervise, to intervene, to pull the plug if market conditions change in a way the AI was not trained to handle. The second is the confirmation bias loop. This is where you, the human, have already decided you want to buy the euro. So you start tweaking the AI's parameters, ignoring the sell signals and highlighting the buy signals, until the AI's report confirms what you wanted to believe all along. This is using a powerful tool for self-deception. A true CEO challenges their analyst. If you're bullish, you should explicitly ask the AI, "Give me the strongest bearish case against my position." Forcing yourself to confront the opposing view, backed by data, is one of the most powerful habits you can build. And finally, there's the over-reliance syndrome. This happens slowly. You start to trust the AI so much that you stop doing your own human analysis. You stop reading the news. You stop checking in with your own mental state. You just look for the green light from the machine and click the button. When this happens, your skills as a trader begin to atrophy. You become a fragile operator, completely dependent on one tool. And when that tool inevitably has a bad day or a bad week, you have no foundational skills to fall back on. The goal is to be a great trader amplified by AI, not a button pusher replaced by it. We've covered an incredible amount of ground in this series. From understanding what these AI tools are, to exploring specific platforms, to now building a disciplined framework to integrate them. But I want to leave you with this final thought. This is not the end of the story. This is the beginning. The field of AI in finance is moving at a blistering pace. The tools we discussed today might be obsolete in 18 months, replaced by something faster, smarter, and more powerful. Therefore, your ultimate strategy cannot be to master a single tool. Your ultimate strategy must be to master the process of learning, adapting, and integrating new technologies with timeless principles of discipline and risk management. This framework, the CEO and the analyst, the confluence protocol, the rigorous journaling, is not tied to any specific software. It's a mental model that will serve you no matter what the future holds. Your journey is just starting. The real work begins when you close this video and start applying these concepts. Start small. Test everything in a demo account. Be skeptical. Be curious. Keep a journal of your experiments and your findings. This is your personal research and development project. The insights you gain from your own disciplined practice will be more valuable than anything you can learn from a video. So, I encourage you to take this framework and make it your own. The future doesn't belong to the traders who can predict the market. It belongs to the traders who can adapt the fastest. By building a robust partnership between your own human intuition and the powerful logic of artificial intelligence, you are positioning yourself on the cutting edge of that future. The story from here is yours to write.